So I'm pretty familiar with the investment products in Singapore. And as the head of investment here in St. Joseph's Place, Singapore, what I do is mainly to manage the investment team in Singapore, and that team will then provide the support to partners like WeKai in terms of investment advisory, portfolio updates, fund updates, communications, and analysis. So I'm closely working with some of the investment committee, both in the UK as well as in Asia, and I'm a key member of the Asia Investment Committee as well as the Portfolio Committee here. So I'm pleased to have you here. What I'm going to do today is firstly just to share, spend 5 minutes, the first 5 minutes talking about the St. Joseph's Place investment management approach. As like what WeKai has mentioned, some of you may not have been clients with us yet, so it's good to understand how we manage investments, how is it distinctive from some of the other financial institutions out there. And after that, I'll move on to a review of the markets and then talk about some of the global outlook from some of our fund managers, followed by some of the key principles that we should look at to stick to when we want to manage or ride through the market uncertainty going forward. And after that, I think we'll follow up with some questions and answers, which I believe WeKai will facilitate. So with that, I'm going to start off quickly with a brief introduction of St. Joseph's Place investment management approach. So in SJP, in St. Joseph's Place, what we do is that we manage our own funds. We have our own funds, but what we do is that we actually, we do not have our own fund managers to manage our funds. So what we do is we outsource the funds to the third-party fund managers to manage that. And with that, we are able to select managers from all over the world, be it them managing retail funds, institutional funds, or accredited investor funds, or they may not have a presence here in Singapore. We are able to engage this group of managers to manage our funds accordingly. So we actually set the mandate, we set the objective of the fund, and then we leave that fund mandate to the managers to manage accordingly. So they have to stick to what we ask them to do so. So in terms of selection process, we are able to select managers from a wide pool of talent. They could come from Asia, they could come from Europe, UK, or the US, it doesn't matter. As long as they're the best, we are able to select them to manage our funds accordingly. And secondly, we have a strong monitoring process in which we monitor the managers on a regular basis. We hold meetings with them, and it's even easier right now with the use of technologies currently. So just to give you some figures, across 2019, we conducted more than 600 manager monitoring meetings with the managers. So that's about 2 on every day, including weekends if you want to include them. And thirdly, we can change managers as and when we want to at no cost to the client or the investor. And some of these change could include events where we actually change the mandate and we find that the managers may not be the suitable one to manage the current fund mandate or objective currently. So we can change them accordingly. Or it could be the case where managers retire or they leave, or it could be a case whereby managers do not perform to our standards and we can change them accordingly. And in terms of the select, monitor, and change process is done via the investment committee in the UK. So we have a strong investment committee supported by the investment team, as well as the independent consultants like Stanford and Reddington, which you see here. And what they do is they provide advice or they shortlist the managers that we can look at in terms of fund manager selection. And then what we do here is then continue to manage those managers, to choose those managers, monitor them accordingly, and think about changing them if need be. So we set the performance objectives, we set the risk management and strategy, and then we monitor them and manage accordingly. So this is just an overview of where some of these fund houses or the managers could come from in terms of where they are based, as well as their fund house. So you could see some familiar names, for example, First Sentia, which was called First State previously. You could see names like BlackRock, you could see names like Schroders. You may even see unfamiliar names that you may not have come across, like MFG Asset Management based in Australia, but they are actually one of the best managers in terms of managing international equities. Some of the managers, as well as, for example, Aristotle, Oaktree, may not be fund houses that you are familiar with, but we can get access to this really great talent to manage our funds accordingly. And just to highlight some of the key benefits in terms of the investment management approach, with this, what we call a segregated mandate approach, whereby it's a kind of institutionalized approach. We have the ability to change the managers freely. We are able to negotiate fees with fund managers because of the pool of money that we have. I believe what Wee Kai has mentioned, we manage 200 billion Sing dollars worth of assets under management. And with that, we are able to have a strong bargaining power when it comes to managers managing our funds, and we can negotiate the fees down further with these managers. And that's the power of having that institutionalized kind of framework. In terms of fund flows, what we have seen is that it has always been very resilient in terms of fund flows. Some of the managers whom I come across with, they talk about how their fund flows with their external funds that they manage is very different with ours. What they are seeing with St. Joseph Place fund flows is that it's very resilient, it's always very consistent and on the upward trend. As compared to their own funds, they could see strong big flow, outflows and inflows as well due to markets. And for our side, the clients stay very much invested with us due to the faith that they have with us as well. I think Wee Kai has mentioned that as well. Whole of market, we are able to get access to a wide range of managers without any restrictions. And mandate customization refers to the control that we have in terms of how we want the fund to be invested in. So for example, when we pass that particular mandate to a manager, we can set it as, do we want to have just exposures to mega cap and large cap stocks only? We can actually set those mandate and get the fund managers to make sure that they follow the mandate accordingly. So there's additional layer of risk management over here from St. Joseph Place. And of course, portfolio transparency. So what we can do here in the investment team, both in Asia and in the UK, is that we are able to see what the fund managers are doing on a daily basis. So just to give you a brief overview of the funds that we have available, it ranges from government bonds to corporate bonds to mixed assets to UK equities, as well as global equities here that you see, and then some of the country or regional specific equity funds, followed by emerging markets as well as smaller companies. You'll notice that each funds are managed by various managers, and some of those funds could have a multi-manager strategies in there as well. And when it comes to portfolio, what we are doing here for clients, what we are doing when it comes to a portfolio for clients, what we mainly do is that we create a few portfolios for our clients, a few model portfolios for our clients. So ranging from a lower medium risk to a medium to upper medium risk kind of profile for our clients. And what we do is to use some of the most of the funds available through the St. Joseph Place framework. So there's SJP funds, and we form a portfolio according to those funds. So that's a brief overview of St. Joseph Place and how the investment management approach is very distinctive. I hope that answers your curiosity if you have any on St. Joseph Place way of managing funds. And with that, I'm going to move on quickly to the global outlook and the global review of the markets, as well as the outlook. So in terms of 2020, I believe this has been a very special year for every one of us for obvious reasons due to COVID-19. And in this case, what I'm showing you here is a chart that shows the various market indices across the world. And you will probably notice that there's a big dip in March, and that's no surprise. And which culprit is that? And it's COVID-19. And what we have seen is a very strong recovery in the markets since then. So what spurred the markets going forward from March was, of course, the easing of monetary measures, as well as the lowering of interest rates, cutting rates across globally. And that created a lot of liquidity, a lot of support for some of those risk assets going forward. And that is why you see a strong rebound in some of the markets. And of course, there are certain markets that did not do so well or probably did not recover back to its where it is year to date. For example, the UK equity market as well as the European markets. And some of these two markets are quite highly dependent on, firstly, global trade, as well as for Europe, it's quite highly dependent on tourism as well. So that is one of the reasons why these two markets have not been doing well. And of course, the uncertainty that's revolving around Brexit has not helped these two asset classes. And of course, from what you see here, some of the markets like emerging markets or part of Asia is doing pretty well. This year we have recovered quite strongly. Of course, the US markets, no surprise. with the inclusion of a lot of tech stocks in the index, have done pretty well as well with that recovery. So I think what we have seen over the recent year is that Asian markets have been coping with COVID-19 pretty well. For example, the case of Singapore, where we are moving towards phase 3 on the 28th of December. So that's really good news for Singapore and for most parts of Asia as well. As compared to the US markets, whereby we probably will see a continuation of lockdowns in some countries. So just to give you a few figures or data to look at in terms of how have we been coping, or how the global economy has been coping with COVID-19. And what we have seen so far, as you can see from this chart here, it shows the US GDP growth quarter on quarter over years. And what you are seeing here is two red lines, and that shows a drop in GDP numbers quarter on quarter for Q1 2020 as well as Q2 2020. However, in Q3 2020, the numbers showed a very positive picture, whereby we have seen a strong, almost 33% gain quarter on quarter in terms of the GDP growth. However, one thing to note is that whether the US economy is going to continue on this recovery path could be uncertain as well. There's still going to be a lot of uncertainty in terms of how markets could be going forward, which we have experienced so far. And of course, huge amount of government and central bank stimulus is going to be required. And we have just heard just yesterday that, yes, we're going to keep interest rates low. We're going to continue with the monetary stimulus in the market in the US. So that's what we have been hearing so far. So a lot of support is still going to be there to help some of the small businesses and individuals globally. And if you were to look at how the recovery took place, what you are seeing here is the GDP figures of the US market. So what we are seeing here is quite a strong V-shaped recovery this year in terms of GDP figures. So we have seen a sharp drop in GDP numbers in Q1, in Q2, but a very sharp recovery in Q3 as well. So this is what we call a V-shaped recovery in terms of the GDP numbers. However, it's actually quite close to the 2019 levels currently already. So we are seeing a lot of positive signs in terms of the recovery in global markets and in some of the big countries out there. And in terms of COVID-19 cases, well, that has always been rising throughout this year. Of course, there are countries which still continue to see an uptick in cases, and that includes countries like US, the UK, Italy, Spain, and countries like that. So these are some of the countries, especially in Europe, in the UK, that we are seeing a strong uptick in cases. And of course, some of the countries are experiencing further lockdowns measures, and that could still continue to pose an impact to the economy going forward until these lockdown measures are lifted, or we could see a much more development on the vaccine front, which I'm going to share shortly later as well. So this is just a brief overview of how cases have been and how they have been increasing over time. And in terms of the outlook, what we have seen this year is probably two key events that we have seen so far. One is, of course, the COVID-19 impact on the markets. And throughout this year, a lot of investors have been looking closely at the US presidential election. And some of the clients have been feeling a bit jittery about how that could have an impact on the markets. Could it be negative? Could it be positive? A lot of question marks prior to the elections. But what we have seen so far is still that markets has still continued to rally despite that. So what we are seeing here is more or less a Biden presidency victory. In terms of that, what we are seeing, or what most of the fund managers are saying, is that in terms of US-China trade relations, we are probably going to see more or less the same approach, but it's going to be a much more muted approach as compared to what President Trump had been using through the increase of tariffs. It's probably more of a case of collaboration between the US and China for the US and China trade relations with Biden's leadership. And of course, renegotiations with China are going to be continuing. We're going to see it as a significant event, and that could be a very good major boost to global equity markets as well. But of course, what most of the fund managers are saying is that it's going to be slow progression over time across the Biden's presidency period. And of course, European markets have fallen out of favor over the years, or especially during the President Trump's period. And what we are seeing is that relationships with Europe is likely to get better once we see a much warmer relationship between the US and China, and Europe. The export-driven European nations are likely to see a lot more optimism for growth going forward. So that's some of the impact of the US presidential election, and that has spurred the markets going forward with Biden's victory. And of course, the other key news that we are looking at, or what has spurred the market going forward, is of course the availability of the COVID-19 vaccines. As what you can see here is the news from CNN on the 14th December 2020. I got this before the announcement by our Prime Minister Lee in terms of the announcement of, for example, COVID-19 vaccines is going to be available to Singapore as well. So this is what you see for US. So immunizations is going to happen very quickly, and that's going to be happening across US as well as most of the countries going forward. So the availability of vaccines have been announced in November. So successful trials by Pfizer, BioNTech, Moderna has been very positive news, and that has actually spurred markets going forward. And what we are seeing here is US hopes to immunize 100 million people by the end of first quarter 2021. So that's a real positive news, and hopefully that actually helps the markets to go back to normal really quickly. But of course, what's important to look at is that markets are still going to be going up and down. Volatility is still going to be part and parcel of investing and part of the markets. So be it with the development of vaccines or optimism or progress about the vaccine development, we're still going to be bound with market volatility. There's no doubt about that. We're still going to see, for example, global trade tensions could still happen. It's hard to say. And how well the vaccines are working is going to be a question mark as well. Of course, we are seeing a lot more optimism, a lot of great data there. So I think it's important to keep the long-term impact in mind. So what our fund managers have adopted in terms of mindset is economic recovery is going to be coming. It's a matter of when and not if. And we had there is a survey by fund managers on fund managers by Bank of America as well. So a majority of the managers expect the economy to be stronger in the next 12 months, while 66% believe that global growth is already in an early cycle phase, which means the recessionary period has ended and we are looking at a much stronger recovery. Something interesting to share, which has happened in November since the availability of the vaccines, COVID-19 vaccines, is this rotation of value and growth stocks. Just to give you a brief background, what value and growth really means. So value stocks typically refers to companies which are trading lower than what they are really worth, or trading than what we call the intrinsic value of their companies. So these are actually stocks or companies which are usually found in out of favor parts of the market, and usually it occurs to, for example, financials, energy, as well as of course, for obvious reasons, the travel industry market as well. And for growth, stocks typically refers to companies which are growing strongly, their earnings are growing quickly. Companies which are mainly in the tech sector are companies which usually fall under the spectrum of growth. And so growth stocks have been doing well, not only across this year, but across the last 5 to 10 years as well. So in fact, growth stocks have been outperforming value stocks quite drastically by a big margin over the years. But ever since the recovery, ever since the availability of the news of the vaccines, we have seen that value stocks have actually done pretty well from November onwards. And that's what we call a slight rotation into value stocks, whereby the value stocks actually quickly recovered and rallied over time recently. And value stocks usually do pretty well in the stage of market recovery, and that could sustain for quite a long time. So what I'm trying to say here is that I'm not saying that growth stocks are not going to be the way going forward, but what I'm trying to say here is that we need to think about having a blend of investment styles in our portfolio as well. and not just focusing on a particular sector or a particular strategy. So what we look at for our clients' portfolio is to make sure that we have a good blend of the various strategies in place. We don't just look at a particular market or particular strategy. We look at a strong diversification to ensure that clients' portfolio are a lot more consistent and sustainable. And so it's very important that when we come to coming up with a portfolio, it's important to think about some of the strategies within the portfolio as well. I hope that has been a good summary of the markets and some of the good insights. What I'm going to share is more about going forward. How should we really navigate through market uncertainty? I think the first key principle that we should look at is what we call time in, not timing matters. So what does it really mean? So before I really elaborate on that, just to really show you in terms of a chart here, volatility versus equity market returns. So this chart shows the daily returns of the US market from year 1990 till now. And it shows the daily returns in blue, and the cumulative returns is represented by the red line there. So what you're seeing is that the volatility of the cumulative returns over time is actually, if you can see, is actually not high because of time horizon. But the movements in the market on a daily basis can range quite drastically. You'll notice that it could range from positive 12% to minus 10% on a single day, or minus even 12% on a single day recently, in recent years. So that is a big example of how, if we have a good long-term time horizon, volatility is going to be smoothened out over time, and that's going to help you in terms of managing your funds going forward. So it's important to set a good long-term time horizon when it comes to investing. So another chart which I have here, it shows the yearly calendar year returns of the global equity markets. So it's what you see here, the blue bars actually represents the year which the equity market actually ended up positively, and the red bar shows the year where markets ended negatively. So over the years from 1986 till 2019, what we have seen is that the number of positive years actually outnumber the number of negative years. So if you were to stay invested, you probably will experience a lot more positive years as compared to negative years. So we try not to time the market because we do not know when market is going to drop, when market is going to rise quickly. And what this chart also shows you is, if you were to bring your attention to the gray dots there, it refers to the maximum drawdown within the year itself. So if I would bring your attention to year 2009, right, you notice that there is actually a maximum drawdown, which means market actually dropped quite quickly by about minus 23% in year 2009. But the year actually ended up at plus 27%. And that shows that markets actually recovered quite strongly in year 2009 after the global financial crisis. And that is quite a similar scenario to what we are seeing or potentially seeing in year 2020, fingers crossed, is that, yeah, it's likely to be a positive year. What we have seen is that markets have really recovered pretty well and strongly, despite having a big market drop of 30, 35, 40% across in the first quarter this year. So this is what we are seeing. Market drawdowns happen, or market volatility happen on a yearly basis, on a daily basis. It's inevitable. And what's important is really stay invested and have time in the market rather than trying to time the market in and out. Another example I wanted to show is a recent 2 years example. It's a real life scenario, what happens to investors globally. So what I'm showing you here is the MSCI World, which refers to Global Equities Index, which is represented by the blue lines here, together with the long-term mutual fund flows represented by the brown bars. So what the brown bar shows, if it's below that 100 level mark, it basically refers to the fact that, below the 0 mark, it mainly refers to fund outflows, which means investors are actually selling out of their investments, be it equities or bonds. So what you see here is that when markets are down, the fund flows are actually negative, which means investors in real life are actually selling out when markets are down. So what this means is that they are actually fearful of the market. They are actually panicking. They are very emotional about the markets, and that's normal. In behavioral finance, this is what we call the loss aversion bias, in which the pain of losing money is twice as much as the joy of the same size gain. So it's normal that clients feel emotional or panicky when markets are down. And when they do that, they actually lose out. When they actually cash out of their investments when markets are down, they actually lose out on the recovery when it indeed happens. So it's important that when markets are down or volatile, we stay invested throughout and not to be too emotional and cause you to make the wrong decisions. And another chart just to show you an example of why time in is important. This example shows that if you have 100,000 investment in global equities over the last 20 years, if you stay fully invested, just park it there, do nothing at all, your 100,000 is going to grow to 233,000. But if you miss just 10 of the best days in the market over the last 20 years, just 10 of the best days in the market, that 100,000 growth will shrink to 132,000. And if you miss 30 of the best days in the market, your 100,000 will actually be losing money. You'll be actually getting 66,000 at the end of 20 years if you miss 30 of the best days in the market over the last 20 years. So if you miss the best days in the market over the years by trying to time the market, you are going to lose out a lot on your investments. Some examples I have here happens this year. Dow Jones rebounded more than 11% to record its best day since 1933. And that happened on the 23rd of March this year. And that's according to CNBC here that you can see. And of course, S&P 500 booking its best weekly gain in 45 years. And that happened on the 9th of April, 2020. And why am I highlighting the dates here, 23rd of March as well as 9th of April? What I'm showing you here is that actually some of the best days or the best week of the markets happen in the midst of heightened market volatility. So it happens when investors are fearful of the markets. It happens when things are not going too well, when markets are volatile. Some of those good days can happen in between those days. And that could be because of stimulus measures like what we have encountered this year. So what I'm trying to say here is that the best day or best week can usually come right after many days of selling off. So it's important that when you face with market volatility, it's important to stay invested throughout. Try not to be too emotional when markets are weak. Another important principle which I want to highlight is a key, is very key, is about diversification. So diversification actually is very important in your investment portfolio. What I'm showing you here is a very colorful chart that shows the various asset classes and how they perform since 2010 to 2019. As you can see from the chart, that there's no one single asset class that's going to remain at the top all the time. If I were to bring your attention to probably year 2017, emerging market equities in gray is actually a top performing asset. But in 2018, emerging market equities actually was the worst performing asset. And after that, 2019, it started to recover back again to be the second best performing asset. So imagine yourself as an investor, if you try to put yourself into just one single asset class, you probably might be facing a lot of big market movements through one asset class, because that market movement could be quite big if you are just focusing or investing in one single asset class. And that could cause you to make the wrong decisions when markets are not doing that well. So what happens if you have diversification in your portfolio? It means that your returns will be a lot more sustainable, will be a lot more consistent. You will not be faced with too much fluctuations because of different correlation between asset classes. And that's going to help you to achieve a good long-term and sustainable returns over the longer term. And that's why we emphasize a lot on diversification. And in fact, with diversification, what it really helps is that it helps to manage market volatility or drawdown. But before that, let me give you an example. I believe most of you are aware of this fact, that if your investment dropped by 50% in value, you need for it to recover by 100% so that it goes back to its original value. However, if your investment dropped by 30% and your overall investments only recovered by 70%, which is lesser than what the market is recovering, even though that is, your net return is still positive at 19%, which means if you can manage on the drawdown, having a much lower drawdown as compared to the markets, you are actually much better off in the longer term, and you do not need such a big recovery to ensure that you are back to its to your capital or even growing your assets over time. So it's important that we diversify our portfolio, and that actually helps in terms of managing volatility going forward. And another point which I really want to highlight is on the fact about volatility and how it could work to your advantage here. So what I have here is an example of what is a real life scenario. It's a case study which we have done for the first 9 months of year 2020. So what we have shown here is that if you invest as a lump sum at the start of this year with a 90,000 value, of course, markets will go down and up. And at the end of September, what you're actually making is about 93,682, which is a 4.1% gain at the end of September. However, if you were to do a dollar cost average over this period of time, over the course of 2020, by investing regularly over a period of 9 months, your actual returns, if you contributed 10,000 per month for 9 months, your 90,000 will work out to be 99,327, which means it's better than what happens if you invest through using lump sum. So in times of market volatility, it's really important or good for you to think about investing in stages, in bite sizes, so that you capture the market downside. Firstly, because I've mentioned we can never capture the times when markets are down, or the lowest point. It's hard to predict when it is going to happen. We will not know when market is going to be at a higher end as well. So it's important that we think about the longer term, stay invested for the longer term, time in the market rather than trying to time the market. So it's a very important philosophy. And how dollar cost averaging helps is that it removes the need for you to think about timing the market. It's a consistent and disciplined way for you to think about investing when markets are volatile. So I hope this real life case study helps you to understand a bit more about how can we actually navigate markets or through market volatility, and that's going to help you in your portfolios or your investments going forward. And yes, and that's probably all from my end, and I'm going to hand the time back to Wee Kai.
Hi. At this point in time, we'd like to do a quick poll. So at your screen, you should see a pop-up screen. So just a very quick question. Is it the right time to invest? So just click yes or no, then and let's look at the result. Wait for 10-15 seconds. Okay. So with this question, actually, I would like to pose this question as the first question of our Q&A section. And before that, I would like to share the results. And everybody, I think everybody can see. Yeah. So Elson, given the market volatility, is it the right time to invest?
I think that's a trick question, right, Wee Kai? Basically, it's I think it's important that I think we stick to the principle of time in the market. So I think it's always good to invest and to keep your money invested throughout. So I would say yes, it will be a good time to invest. Or in fact, when we think about the longer term or how we want to meet our financial objectives or goals, we need to start investing as early as we can, because with time, it's going to help to grow your wealth over time. So I would say, yeah, investing is important. It helps to grow your wealth over time, and it's important to start doing it as early as you can. Thinking about how you're going to do it is also a great thought process as well.
Okay, we have another question here. So with the current near zero interest rate environment, what do you think? How do you think it will affect future investment yield?
Yeah, I think that's also a very good question. I think over the years, as we have seen, be it quantitative easing from 2010 until now, with strong money supply, with a low interest rate environment, that has always been very supportive for risk assets. And that is why we have seen equities as well as bonds doing so well in a low interest rate environment. And that's going to happen as well. We're going to see a sustained or long period of low interest rate environment. What we are seeing or what we are projecting from the Federal Reserve is that interest rates are going to stay low till 22.2 or 22.3, or in fact 22.3 for most of the members. So the interest rates environment are going to stay low, and we feel that this is going to be very supportive for risk assets going forward, and that's what has caused market to rally as well since March and April this year. So with that low interest rate environment, it's going to help spur the markets going forward. And usually with that, it also means probably inflation could pick up quite strongly. And with inflation, we need to think about what happens if your money are in cash. It means that your principal are actually eroding with inflation when it picks up. And interest rates are low, which means you're not getting any much more from deposits. So with that, it's a double whammy by keeping in cash because you don't get to experience the growth through some of the risk assets. At the same time, you get hit by inflation. So that is why risk assets have been doing well in a low interest rates environment.
See, so talking about risk asset, so is there should we invest in shares or bonds?
Yeah, yeah,
Invest now.
yeah. Primarily, I think we should take a look at clients or investors' risk appetite or risk profile to determine the extent of how much equity exposures to take. I would say equities should form the core because that's going to drive growth over a period of time. But for a much more conservative clients, of course, a higher allocation to fixed income is necessary to cushion the downside risk. For a client who's keen to look at growth, for example, equities is definitely going to be a key component to drive growth within the portfolio. And because equities, like what we know, they are companies, they're company shares. And what companies do is that, for example, when inflation picks up, what companies can do is that they can pass on that inflation to investors or to consumers, for example, right, consumers. Because if prices go up, what companies can do is to raise their prices to meet with that. And so equities, in a way, is a very good hedge against inflation, no matter what. So firstly, a hedge against inflation, and there's always an incentive for companies to keep doing well and to grow their money. So that's the benefit of equities within your portfolio, and that should be a key substantial part of your portfolio, and it should revolve around that. And when it comes to whether is it more or less equities, it should come down to then your risk profile and to think about what other assets should complement that equity component in there. Should it be more? Should it be less? It depends on your risk appetite.
I see. Okay, so talking about the pandemic, you mentioned that some Western countries and US are getting second and third wave. So should we wait until the pandemic is over before investing?
Interesting question as well, because what we are seeing here is that what happens to the economy or what happens currently may not be reflective of the equity market, because the equity market is always forward-looking, which means what equity markets behave is what's going to happen over the next 1, 2, or 3 years going forward for the companies. So it may not be necessarily the case whereby we're going to see probably a lockdown currently, and is that going to be an impact on market? So what they are saying is that over the period of time, how would these companies, would they be able to continue to do well during this period of time, be it through lockdowns or not? So it's forward-looking, and it could be the case whereby when vaccines are in place, could that be beneficial for the companies going forward as well? So it could be a booster from the vaccines. And of course, we have seen a number of mixed news in terms of, for example, positive news coming from vaccines, mixed news coming from lockdown. So it's keeping markets a bit flat as what we have seen over the last few days as well.
I see. Okay, so we have a question talking about technology. just now you mentioned about technology stocks being doing very well in recent years. So what are their views on that moving forward?
Yeah, I think as we move towards a new normal environment whereby we are embracing a lot more on technology, I think is where technology is going to play a big role in everybody's life. We need to embrace it, embrace the use of it. And of course, tech stocks are likely to form a key part of growth moving forward over the next 5-10 years. But of course, what we should not forget is about the principle which I mentioned before is about diversification. Because there could be markets or sectors which could do better. For example, when markets recover, like what I've mentioned, value stocks have actually done a bit more, much better over the last 1 to 2 months when markets started to recover, and they have done better than some of the tech stocks which have continued to rally. As what I mentioned, some of the rally in the tech stocks could be what markets are looking forward that these stocks, tech stocks, are going to be doing well. Over the next 5 to 10 months, 5 to 10 years, for example, and would that have been priced in as well? So it's a hard, difficult question to look at. So I think the key fact here is technology is still going to play a big part in our daily lives going forward globally. It's about striking the right balance within your portfolio to have a good exposure to both technology and, of course, other sectors and other geographical regions in terms of asset classes.
Okay, I'm conscious about the time now, so we'll just take one last question. So this question goes like this. In anticipation of the aviation industry recovery, do you think we should go into that market now?
Well, it's also a very interesting question, right? We should not put all our eggs into one basket. It also depends on how well there's still a lot of uncertainty revolving around the aviation markets. And ever since news of the vaccines came up, aviation stocks have actually rallied quite strongly. And that's because markets have been pricing in strong recovery, or that there's hope that people can start traveling soon. So that has been more or less been priced in. So I think the key risk here is what happens if traveling is still not going to be happening that soon, or it's still going to be very restricted going forward in the next 1 to 2 years. It depends on expectations on that. Are we meeting expectations? So it's going to be a hard decision. So it goes back to where I would emphasize on, yeah, we could have some exposures to the aviation industry, but I would say it's probably we need to allocate quite properly, and that's through the expertise of certain fund managers to really allocate them accordingly. There could be areas whereby, for example, consumer staples, quality stocks, technology, healthcare, financials could still play a big role within your portfolio, and about striking the right balance once again.
Okay, so thank you everyone for staying with us. I'm conscious of your valuable time. So with that, I'd like to give a big thanks to Elson for the informative session. We know that some of you may still have some burning questions. We'd like to get in touch with you and hopefully also to gather some feedbacks for our own improvements. Thank you once again, and goodbye.
Thank you.